Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin. Hey, there's a bubble. Welcome back to the Loonie Hour, episode 38. As always, joined by the three amigos here. We got everyone's favorite boomer with his fancy new white shirt, Keith Dicker, Ice Cap Asset Management, and of course, Rich Diaz on a boat. Rich Diaz of Acorn Macro Consulting. Welcome back to the show, gentlemen. So I think last week we had Keith with what are we calling it? The mountain fever. And then we've got Rich, who's on a boat, the Love Boat, somewhere on a cruise. So he might be dipping out. He's got apparently there's a mandatory safety meeting. So we might lose Rich mid-recording here. What else is going on?
You might hear announcements to do with life jackets and masks and all kinds of stuff. So
alarms going
apologies
off
in advance, gentlemen. Thank you for
You have to
accommodating
wear a mask if you go overboard. What?
Probably. We've been tested. You have to be vaccinated and you have to wear a mask even when you're on deck. The world,
even when you're outside on the deck.
Let's change the subject.
In the middle of the ocean.
Well, guys, I was in the mountains last week for a few days, and I grew up at sea level my whole life. I had sea all around me. My dad was a fisherman. Like, I love the sea, but I really love the mountains too. Like, it was pretty good. And I think I'll just at some point, just get one of those vans and grab Willis and head off and not come back. Maybe
you take your gold bars with you.
Take the gold bars. I shared that
and
with
your microphone.
Mrs. Ice. Well, I shared it with Mrs. Ice Cap, and she said she's going to miss Willis.
I miss Willis. I've never even met him. What else is going on? Big Colorado Avalanche win.
Oh yes, congratulations.
Yeah, we had a lot of our followers, supporters there DMing me on the win, so it was kind of funny. Stuck around for Game 6, and what else is going? We haven't missed a beat. Rich is on the Love Boat. Keith is in the mountains. I'm actually getting married next week, so
I'm in Iceland actually. The Love Boat is in Reykjavik, which is a really cool town. We partied on Tuesday night and the sun is up. I know it sounds dumb because people always talk about the land of the midnight sun, but it's one thing to say. It's another thing to be out at 11 o'clock pounding pints in the bar and just it's bright as it is in Halifax. So
it's an excuse for you to keep going.
Yeah, exactly. It is, but
anyway, one of the biggest
guys.
parties in the world is up on the west coast of Sweden. Is it Gothenburg? I think I might be mispronouncing it.
Yeah.
But they had the Midsummer's party up there, which I think it lasts for 3 days. Like, those guys are, they really know what they're doing.
Maybe that should be our next Loonie Hour event.
Yeah.
Oh, I'm down.
Yeah, see Boomer going to bed at 6 p.m. as usual. So there we go. So let's get on, guys. What's happening in the world today? Markets stuff?
Yeah, I mean, we'll go around the world as we always do. We'll start domestically here. So I started a regular monthly show with John Pasalis, who's a really excellent realtor out in Toronto. We had that Yahoo Finance show together. So we've been kind of sharing some information back and forth. So it looks like the GTA, Greater Toronto there, will have the weakest number of home sales for the month of June in 20 years. So obviously, as you can see, those 5% mortgage rates are really starting to bite Canada's largest housing market in the GTA. And then if I look here in Vancouver, Greater Vancouver home sales are coming in really quite weak, but it's actually the bulk of the impact is actually coming in the Fraser Valley, which is our suburban housing market. So we're on pace to have the slowest June in just over 20 years. So that sort of pandemic trade, right? I think that pandemic trade of work from home, remote work, low interest rates, pushing up the suburbs. And I think it's the same as like that tech play, right? It was like, hey, listen, like get long all these, get long Zoom and Peloton. And as you're seeing that market sort of obviously get flushed out, I think that the suburban market here is where you're going to see a lot of the pain. And that's the same thing in GTA. Like when I talk to the realtors over there, it's that suburban market that went up so much. And actually, funny enough, I actually have one of my good friends coming to town next week. He runs a massive, I won't say massive, but he runs a very well respected. I'll leave the name out because if I give the name, everyone will probably know who it is. But he runs a finance firm in Ontario, and so he's coming here, and he's like, every year he puts on like a conference where they kind of do like these tours of the housing markets and kind of like feet on the ground. They basically do a sentiment check on the housing market. And so he's coming to Vancouver and he's like, oh, okay, let's go set up all these crazy pre-sales and let's go tour them. And let's go look at West Vancouver again. And I was like, man, because like last time he came, West Vancouver had it was like this huge crash basically that happened there. All these luxury homes basically dropped 30 to 40%. And I was like, man, there's no bubble there this time. I said the bubble is out in the suburbs. So long-winded answer of saying very interesting, because I think there's always a lot of parallels to what is happening in the equity market, which is like, as you see that rotation, and I think we're seeing that rotation now post-pandemic in the suburban markets. So that's what's on my radar. I don't know, Rich, I don't know if you're watching anything on your vacation there besides slamming pints, but
I mean, the thing that stood out for me was just more bad news from Germany. I can't remember the exact number. I think they lost 133,000 jobs. And I think what was expected was like 5,000. I could get the numbers wrong, forgive me, but it's definitely more than 100,000. And it's just, I mean, it's really quite something. But that contrast that with the latest tick in industrial confidence in Euro area, which actually sort of ticked up. I mean, it was still, so obviously we're off the highs clearly, but I think that there's sort of like a bifurcation of sort of different economies in Germany. I think, in Europe. I think Germany's doing, pretty badly, and other parts of Europe. Spain, despite it's like another sort of high in the inflation number, is actually doing okay. I was looking at Italian industrial production, construction. After like years and years of doing really, really poorly, it's starting to grind ever higher, which is a mystery for an economy that's so kind of screwed up. Other like the Euro area's services component for the confidence, they have retail, they have construction, they have industrial confidence, and another one they have is services, and that just keeps holding up. And so, maybe I'm starting to think that the services section, which is probably is not necessarily affected by supply constraints and stuff, is doing okay. And then Germany just continues to crater. So,
Keith, I mean, I don't know if you have any comments on this, but I just wanted to touch on, we chatted about it last week, actually. And I chatted with your buddy, Keith there, Michael Nicoletos, put it up on my YouTube channel for everyone. Let's go check it out. But we kind of we're chatting about the Eurozone, and their discussion about the anti-fragmentation, right? Basically, the concern about what's happening with, Italian government debt, obviously yields spiking over there. Putting that country under a lot of pressure. And so the ECB came out with an announcement today, actually, that they're going to be channeling cash from north to south in a bid to cap spreads, basically to cap yields. So basically what they're saying is the ECB is to reinvest the PEP proceeds where spreads have widened. So basically they'll buy bonds from Italy, Spain, Portugal, and Greece, with some of the proceeds it receives from maturing German, French, and Dutch debt in a bid to cap interest rates. Keith, I don't know if you have any thoughts on that, or maybe if you can even, for maybe those that are a little bit confused, I don't know if you can simplify that and how you perceive this from a market perspective as well.
Well, from an overall perspective, I mean, I've been following these ECB now for a long time, and they continue to come up with one new piece of duct tape after another one, year after year, crisis after crisis, and it still doesn't solve anything. So I mean, the like the illness they have is that they have too much debt and they're not able to get the private sector to buy it. So by default, the public sector, which is the ECB, you know, they have to buy it all. And all these programs they come up with, like they're continuing just to treat the symptom. And the symptom of bad debt is that you have to continually pay more to borrow more. So these programs, they do nothing. Like it might, you know, calm things for a little bit. But if you're in Northern Europe, you know, one way to get the spreads to try to you know, converge back a little bit, you know, maybe they just slow the rise in spreads for Italy and German debt spreads, and the Dutch, you know, their spreads go higher or something. But this is nothing. Like this doesn't fix the overall problem, because the overall problem with Europe is as I mentioned before, in 08, 09, their commercial banks were just stuffed with bad loans, but they weren't able to write them off, because if they did, they had no new private equity coming in to replace that capital. So they had to keep it on their books. And so because of that, you know, I remember a few years ago, I think it was a Canadian firm, they set up this European bank ETF. And the whole investment thesis behind it was that, hey, it's incredible valuation. The price to book was like, you know, 75% lower than everyone else. And of course, if anyone really knows, you know, their investment analytical tools that we use on the fundamental side, you know, if your price to book is completely different than everyone else, it just means the book value is not correct. You know, it's Rich shaking his head, of course, because we all know that's the game that works. So, you know, the short answer is Europe is still screwed. You know, it is still the economic fantasy land called Europe. And which I think it just ties into another point that I'll mention on in a second. Maybe Rich, did you want to comment on the
Well, yeah, I mean,
European book?
So, you know, so it is an economic fantasy land. I like Europe better than Keith does, probably because I enjoy Tempranillos and cheap pasta. But I think the technical term I think that they're dealing with is this concept we discussed briefly a while ago, which is this impossible trinity. It's like a really good pickup line, according to Steve, right? We talked.
Here we go. Yeah.
Here we go. But it's really important that people sort of get why Europe's always going to have this issue until they just concede and share a budget balance. Share a government balance. They just share, you know, government spending unabashedly throughout. And the impossible trinity is free capital flow, fixed exchange rate, and sovereign monetary policy. And you can only pick, you know, one side of this triangle. You can only have free capital flow and fixed exchange rate. And then, or you can have free capital flow and sovereign monetary policy and fixed exchange rate and sovereign monetary policy. And that's the problem with a country like Italy, which probably needs a significant internal or external devaluation. But because its fixed currency is attached to Germany, which needs probably a currency revaluation, but upwards, you have a situation where the only way to square that circle is for significant amounts of money to be transferred from the north to the south. But the problem is German people in their, I'd probably rightly, are not interested in having their tax dollars shift from Germany to different parts of the periphery. This was true in 2011, 12, and 13, 14. Mario Draghi, the 10th anniversary of him saying, you know, whatever it takes. And they sort of, you know, dealt with this issue through the back door, but really they just kicked the can down the road. There are other examples of this kind of dislocation in productivity or and in budget balances and current account balances. You know, I would argue that Germany and Italy are probably closer together in GDP per capita, productivity, maybe even culture than, let's say, Mississippi and New York City. But those two states are part of a United States of America, and in their constitution, and they have a mandate to transfer wealth from New York and California and Texas and other rich parts to the poor parts. And so that's just sort of well understood. It's part of what it is to be a country. Canada has the same thing too. You know, the rest of Canada pays for Halifax and Nova Scotia. That's just the way it is. But in Europe, that's sort of not the deal. It's not what people signed up for. And until they deal with that specific issue, you'll always have, it is the fantasy land. And so the sooner they address that issue head on, the better it will be. Now, the question is, will that ever happen? People like Keith have probably rightly suggested that it will never happen. I'm an optimist, so I think eventually the Germans will just suck it up and pay the other countries. But I don't know. That's the sort of a more technical sort of angle to that whole problem.
Just curious, while we're on that point, does anyone know how much like Alberta pays from their slush fund there to the rest of Canada?
I don't know the number, but I know they, Alberta's been a net contributor, to the whatever that scheme is called.
Well, they just basically send their oil proceeds to the rest of Canada, essentially, and then everybody in Canada says to get rid of the oil patches.
Yeah, and then a few years ago, when they had, they struggled in the oil patch. I have a lot of friends up there, and they really struggled, and it's just my perception. But the perception, from national media, and in Toronto, and so, like, no one empathized or sympathized with them at all. It was just wrong, completely wrong. So, it's one thing that makes Canada such a great country is that we're going to have parts of the country that's working really well at times, other parts that are not working so well. But we all have, different, lifestyles and cultures and stuff like that. But we've always pulled together. But yeah, I just think Alberta's getting a bit of a wrong end of the stick or raw deal with it. So I don't know what the number is.
Well, hey, I mean, it sounds like Rich. I mean, it sounds like our buddy JT might be listening to the Loonie Hour here, because Canada is talking about expanding infrastructure in oil and gas here. It may expand LNG infrastructure to help Europe. So there you go.
I mean, this is the thing that Canada can, like, I know we're switching gears really quickly here, but this is the thing that Canada can really do. We can use our energy resources as a force for good in this world. I think we should never sort of forget about that. But there's another thing I wanted to talk about, just because it sort of brings back a topic we discussed at the end of last week's podcast. Hopefully hopefully people stayed awake for the last section when we talked about the PMIs. And so China, so we, every country's got a PMI, and China's obviously one of the most important economies in the world. They have a PMI. Now, some people might discount its reliability. I think that the PMI is sort of a difficult thing to screw with. And, both the manufacturing and non-manufacturing PMIs have snapped back significantly over the last month. One is the non-manufacturing PMI bounced all the way back to 55, which is a really, really solid number. And the manufacturing PMI is now above 50. So this is obviously sort of the legacy of the perpetual COVID policy, but just, sorry, a really important sort of data point that I think listeners should know that that's happening. So
they are talking about, well, no, I mean, I guess I'm assuming that's predominantly just because they're reopening their economy. I don't know if you guys read that. China's announced basically that they might have a COVID zero policy for the next 5 years. I don't know if you saw that.
I saw
it. Guys, so, I love Rich for having so much faith in data and numbers and everything, but I just think it's, the Chinese are awesome because what's the population in China? I have no idea.
1.4, 1.3.
1.4? Okay. I knew it was 1+. But they're able to calculate their GDP to the penny within hours after the quarter is over, and there's never any revisions to it. Whereas everywhere else in the world, where, with, Statistics Canada and the Bureau of Labor on the US and, all these entities, you can never get it on time. And there's always revisions and discussions on what the numbers should be. Unlike Rich, by the way, Rich, I think you are much too kind to me with my optimism for Europe. My target price for the euro, it's I think we're about 105 points away from where it's going to go, which is 0, by the way. I have very little confidence. We'll put it this way. The only way the Eurozone can even remain as it is right now, the world needs to recover significantly. Debt has to stop growing. Debt has to be paid down. People have to be happy. They have to start liking each other. The Chinese and the Russians and the Americans have to start we need this perfect world. And maybe in Europe, they have that perfect world and, in their fantasy area. But again, just to reiterate, I have zero. I love Europe, by the way. There's lots of fun things to do there. The food is great and all that, but economically and financially, they're really at the end. And the Japanese are in a much better position than Europe, and that's telling you something. So that's my love for the.
Okay, let me just push back. I think you need to concede that if tomorrow the German population said we want to send trillions of euros, sorry, not trillions, sorry, hundreds of billions of dollars over the next 20 years or whatever to the southern part, to the periphery, it would change the math on a lot of this stuff. I think that that's just part and parcel of the euro area as a problem. So I think if they rectify that specific issue, but the other thing I would say is, so much of these Southern European nations, their GDP comes from tourism. And Portugal is like 8%. France is, another 8%. So the lower and lower their euro goes, the better a tourist destination it becomes. And who knows?
I might be going there. Working on a honeymoon plan right now, baby. So I'm hoping that currency exchange rate. Let's hope the Trudeau bucks can hold up here.
The Canadian dollar to the euro is at a 7 or 8 year high. So,
That's
you should
fantastic.
take advantage.
My first trip to Europe was in 2003, I think it was. So the euro is at around 88 cents USD, 89 cents. It was good. Yeah, pretty good. So, but with, again, just being pragmatic, what Rich said, if the Germans did this and the Italians and Spanish did that, those are pretty big ifs. And I'm telling you,
I'll concede that's true.
Like 0% plus the smallest number that, Rich can calculate with all of his spreadsheets and everything else. This ain't going to happen, guys. And so the other thing as well with Europe, and what's very different from Canada and America, in Europe, they would have to combine they don't have a federal debt issuance. So in Canada, we have federal government bonds, right? In America, they have treasury bonds. In Japan, they have JGBs and so forth. There is no federal bond issue in the Eurozone. So the only way that can happen, they have to combine all the debts. And Northern Europe will never pay for the Italians and all the debt they borrowed, right? And at the same time, if the Germans turned around and said, hey, yeah, we're going to bail out Italy, the Italy's might say, no, thank you. We'd rather be out of here than living under the thumb or the boot of the Germans. Like there's a lot going on there. So anyway, but if you're bearish on one market, it means you're bullish on another market. That's just the way that markets work here. Maybe we can turn over to market wise a little bit.
I was going to say, what are we bullish on then?
So I think
GICs.
Oh no. So let's just talk about the Canadian banks for a second here.
Hey, GICs are you can get a 1-year GIC for 4%.
That's actually not a bad number. I mean, Keith said no, but 1 year, Keith, the Bank of Canada's not going to go bankrupt in the next year, is it?
100K CDIC insured. I always look at things and say, why is the bank offering X% for capital, for your money?
Keith is more of a stable coin guy, 10% yields.
That's one of those crypto things, right?
Yeah.
Yeah, I missed that boat.
For the best, I suppose.
Maybe he's a bit lucky. Just ignorance helped out on that one. But right now, I mean, the narrative that we've been talking about for a while, and again, every day we look, okay, is this playing out? Is it changing? Every day we're now increasing more evidence that the probability of the global economy slowing or going into recession, it's getting higher and higher all the time. I don't mean it's at 90%, but whereas it was low single digits a few months ago, now I bet we're at like 30%, and it's coming, guys. And I think if we do get this slowdown, which I think potentially can happen, it's going to be a pretty dramatic hard break on the economy. So then you have to ask, what happens with markets in that situation? So first of all, that's extremely positive for government debt. So federal government, Canadian bonds, not provincial. The provincial bond market has no liquidity, so it's kind of hard to do that one. But treasury bonds in the US, you could also see Japanese yen do a complete 180, in the market. So all these things are starting to shape up. So this morning, I know the Canadians, we have monthly GDP numbers, and you don't take them at their absolute value. You take them for the trend and where they're moving. But the number that just came out for May, it was a negative print. It surprised people, but a lot of the energy numbers sort of screwed up with it. But
I'd push back on that and say there's the old joke that Canada's GDP is called the random number generator, because they ended up having like these massive revisions like a month or two later that, like, I don't know. I don't put a whole lot of stock in them, obviously, but I mean, it's something worth discussing. But even as someone that might be myself a little bit more bearish at times, like seeing some of these GDP prints in Canada, you almost have to fade that noise.
A little bit, but the point is, though, we're starting to see more data now. Like the German data this morning on employment, like that's not great news, right? It's not good. You're starting to increasingly see more of it, and you're also starting to see, I'm seeing in different research reports as well, and the guys I know, they're saying, hey, Keith, like the inventory accumulation that's taking place on the retail side, it's significant right now. It's building up. So one of the guys I know, he's saying, hey, Keith, we could get this situation in the fall, just as the economy is slowing down. All of a sudden, retailers, their inventories are stuffed to the gill, because inventory build has been one of the key contributors to economic growth over the last 9 months. But we can have a situation where all of a sudden the economy slows. Blue collar workers, they'll continue to do well because there's such a demand for trade and all that stuff. The service side, so people working at the hotels and restaurants, you can see that all of a sudden fall off. And anyone looking to buy a nice new Patagucci jacket, you might get one on liquidation sale coming
there you
up
go.
in the fall.
Keith is licking his chops over there.
I know. You guys remember that movie Whiplash that came out a few years back with the drummer?
No.
J.K. Simmons was the teacher. Anyway, great movie, but
Boomer.
I never saw it. Was that a good movie?
Yeah, he's one of my most favorite intense characters I've ever seen on a show. But anyway, without giving away the whole storyline, you get just he is who he is, and at the you don't like him at all, by the way, and that's a sign of a great actor. If you really dislike a character, wow, that this actor's doing a really good job with it. But at the very end, all of a sudden, you get this whiplash effect. The movie just does a complete 180, and everything that he wanted to see, it finally happened in the end. I think we could get this whiplash effect in the economy coming up, where everything's been going so well. All of a sudden, we come to a hard stop, and central banks, they have to stop raising rates and things like that. And all of a sudden, inflation starts ramping up again on the commodity side. And like everyone is so confused and markets are bouncing everywhere. I just think we have that environment coming up. So, if you look at investment returns year to date, we'll go through some of those numbers as well. But just think of all the markets that everyone has hated over the last, 9 months, and the markets that they've loved. You can see that flip to 180 for say 6-9 months or so, and then it'll flip back again. So I think it's a real good opportunity for people who have the tools and analytics available to potentially place some of that. So we're excited. I think that's cool.
I question for maybe Rich here, Rich and Keith. But so I just noticed that corporate high yield spreads continued to sort of widen above their above their December 2018 levels. Of course, that was the last time the Fed pivoted. Their dovish pivot. So I don't know if you have any thoughts on that.
Yeah, I've noticed it too. I mean, we talked about that a couple of weeks ago. I think it was the right call to make, just as far as sort of teaching listeners and just honestly, just the discussion internally between the three of us to be sort of on the lookout for signals of things that Keith has highlighted. Keith's a bit more bearish than I am. I think he always is. Maybe it's because it's age. What are you gonna do?
Wisdom.
But I think that the point about the spreads going up for sure. But just to keep in mind, the spreads are still well within average, but they never stick around the average, do they? They always either blow right through or go down. I would just say, like, there's one kind of I think I'm a born contrarian. I don't know why. Maybe because maybe I can't tell why. But and I just feel like on the recession front, even though I definitely see the signals. I'm definitely worried. It's, Keith's point about the probability going from low single digits to, who knows, 30, 40%. I get it. But this would be like, when everyone is convinced that something's going to happen in the markets and everybody is pushing in that one direction. And, when you're reading it on CBC and Bloomberg, I'm always skeptical, and I'm just like, well, maybe we've got this wrong, and I think it's also true for markets, although I agree that, maybe there's an opportunity in the bond market as people start to price in weaker growth and price in cuts that might be coming after all these hikes. The equity market in some cases is down 30-40% in some sectors. You could say, Rich, of course it could fall lower. But historically, when you get these massive declines, it might be possible that the risk assets have actually already priced in what we're about to feel economically. And so I wouldn't necessarily go out and sell your equity portfolio at this stage. You know what I'm saying? Like, the market is a forward-looking indicator. It's a discounting indicator. So it may have already discounted what we're about to feel sort of in the lagging economic data, whether it's, weaker retail sales or weaker labor market or higher credit spreads or whatever. So I think the market's, smart, and it has obviously sussed out what's going on economically. And so that's why, when I hear this talk about recession, and I'm just always a bit, maybe I'm just like, actually, maybe now's the good time to start thinking about rotating into some things that have been beaten up. And anyways.
Hey, is the Atlanta Fed the most bearish Fed? Does anyone know?
So the Atlanta Fed does this thing called the GDP Now, which is like they basically try to aggregate like hundreds, if I'm not mistaken, at least dozens of different indicators into some sort of forward predictor over the next quarter or 2 quarters. Is that the one you're talking about?
Well, yeah. So the U.S. Atlanta Fed GDP Nowcast just came out. So they said Q2 is going to be -1% versus a previous estimate of 0.3% growth. So
that'll be 2 quarters in a row. So the interesting story, and again, like people don't understand there's so much competition with everything. So the Atlanta Fed came out with this multi-factor model to predict what GDP is going to be. And it was just as accurate or more accurate than what the private sector was estimating. And of course, if you know the way that the U.S. Federal Reserve is put together, so you have like the Atlanta Fed, the San Francisco Fed, and Minnesota, but New York has always been the king daddy there. And the New York guys get ticked off. So they create their own version of the Atlanta GDP now. They come up with their own name for it. So even within the Fed, you got the New York Fed and the Atlanta Fed competing with each other to come out with an estimate of what GDP. Again, it's a complete mess what's happening.
I remember it was so
good.
It's good.
It's crazy. But Rich said a very good point. And just for all of our listeners, this is something that we've talked about quite a bit as well. The economy and financial markets are never in sync. So just because a recession is coming, notice I just said is coming. So I just changed my mind within like 3 minutes. That's just to annoy Rich. But just because the probability is increasing, that doesn't signal to you that, hey, equities are going to go down further. If a recession happens, earnings are definitely going to come down. So then you have to see what happens afterwards. But just think about this. We've had a pretty substantial correction in equities right now. And if 9 months ago we told you, hey, the economy will be doing okay, earnings will do great, but up to June 30th, then you'll start to see probably a recession increasing. What would you do? You would think that it was after June where equities would come down, whereas it already started. But so again, we're urging everyone, do not believe that financial markets, especially the stock market, is going to follow the economy, because if not, Steve might get a few phone calls on the pod.
Hey, subtle reminder that real estate is your largest asset class in the world, and not bonds, not equities. It's real estate. And so we're still kind of closely monitoring that to see and when it's going to roll over. I mean, I think it's certainly rolling over from a sales volume and activity perspective, which will have sort of economic knock-on impacts when, again, your largest asset class kind of grinds to a halt. But you're not yet seeing those year-over-year price declines, but I think we're certainly seeing month-over-month price declines in large parts of the market. So, and that's not just Canada. I think if you chat and follow a lot of what's happening in the U.S. housing market as well, you're seeing lots of price reductions, and there's some really good data out from the likes of Redfin and whatnot. So yeah, that's a tough one. That's one of those asset classes like that just feels like even if you don't have the Fed put, you have like this like government put that is like implicit in the residential housing market. And like I'm not like advocating and saying that's right or wrong, but it's actually quite amazing. Like, so for example, like here in Canada, right? Like you think about one thing. So, what is every government? We talked about this in the show too, and everyone's like, that's like conspiracy theory. And it's like, no, like governments are actually opting to fight inflation with more stimulus checks, which is like absolutely insanity. But like we had Krista Freeland. Yeah, Rich is putting on a life jacket. The love boat's going down. Krista Freeland's pumping out $8.9 billion of fiscal stimulus, which I think what is it, $500 or $1,000 is going to go out to 1 million renters in Canada are just going to get a stimmy check in the mail to pay their rent. That's basically like a landlord subsidy.
I think we need to give Rich an opportunity to say,
I gotta go. I'm sorry, boys. Thank you very much for accommodating me. This is my favorite, honestly, my favorite day of the week, just because I get to chat shit with you guys. So
this is hilarious. Sorry, I think this is going to be a lot of memes going around with that jacket, man. You look fantastic.
Okay, gotta go.
Okay, good luck, sir.
Gotta go. Bye.
Enjoy the love boat.
Ciao.
And then there were two.
So you get a load of Rich. Yeah, this is my favorite day of the week. I mean, give me a break, really.
Yeah. Like, thank God that guy's gone.
Like Saturdays are fun. Sunday mornings you wake up, you get to do things. But for Rich,
it looks
Thursday.
good. Keith is Friday night at the Ice Cap household pizza night.
Yeah, we've had some good ones. Maybe we should do a
Loonie Hour appreciation.
Over in the Maritimes here, we have a thing we call like a kitchen party. Do you guys have that concept out west?
Never heard of it. That sounds like very small town.
Yeah, here in Atlantic Canada, if you have a party, like no one hangs out in the living room or the wherever, right? Everyone just hangs out in the kitchen for some reason. So
yeah, well, first of all, everybody in Vancouver lives in 600 square feet, so that's part of the problem.
Well, I'm sitting on 8,500 here, so I have a big kitchen. But
no, come on, is your house 80? No, your house is not 8,500 square feet.
I'm just messing with you. Yeah, but we have to do something. Maybe we do an informal, ice cap kitchen party sometime. You get like 24-hour notice, and everyone will come. Something like that.
Yeah, we are a little bit off the beaten track here, but I mean, I will say, we are actually planning quite a few more Loonie Hour events, working with some sponsors on that as well. So there will be certainly a lot more in the works. But
I want to run through some of the performance numbers for year today, because today we're recording this on Thursday, everyone, so June 30th. So
I thought you were going to go over the performance metrics of the Ice Cap asset management portfolio for all the clients here.
For regulatory reasons, I can't do that, but I can tell you that I can
give the thumbs up stamp of approval. You don't have to say anything.
Yeah, for regulatory reasons, we just can't go pumping out on air performance numbers and all that stuff. But we're quite pleased with how we did so far this year. However, let's talk about, because we've been beating the drum quite a bit about the bond market, especially, and how the industry has been pushing conservative investors into bond funds, which, because the bond funds couldn't find any yield, they would push them into high yield bonds, emerging market bonds, maybe some convertible type hybrid securities. But so far, year to date, here are some numbers to think about. So the largest balanced fund managed by the bank in Canada. It's the bank with the blue shirt. So it's $5 billion in this fund. The MER is 2.2%.
And so your management expense ratio for everybody that's following along. So they're charging, hold on, they're charging 2%.
2.2 on 5 billion. Like that's
insane.
Yes, of course.
Because like if you think about it, like
money.
you're like, I mean, let's just, because I want to walk this backwards for maybe the typical listener here, because we do have a vast array of people. Some people that watch the show, I think, are extremely well tuned in and sophisticated, and others are just really just trying to learn. And so your management expense ratio of 2.2%, let's just say, like, I mean, Keith, you tell me, like, what would these guys typically target? Like, I think like they're probably targeting what, a 7 to 8% return.
Well, they don't. So in the investment world,
I mean, they're not targeting something, but like that's maybe what someone can hope for, let's say. And so all of a sudden, if you're giving, let's say you're hoping to get 7%, over a 10 to 20 year period. And if you're losing 2% of that annually to just fees.
Yeah. So all of these funds, remember, they're all structured based on how markets reacted in the 80s and the 90s. So for this one fund that I'm talking about, I don't know what the inception date is on it, but it's been around since the 90s. I can tell you that. All the banks, they're all structured the same way with these balance funds, and same with the non-bank owned investment firms and so forth. So it's like the 60-40 split between equities and bonds. But the bond portion is put together so that it's always going to return between, say, 4 and 8% a year. That's the way it is. So when long-term interest rates are continually declining, that means the return on your bonds are going up. And then when, say, the Bank of Canada rate is between, say, 4 and 8%, as an example, you're always going to be earning at least that much in yield. So getting that 4 to 8% return from your bond portfolio from, say, the 80s to 08, 09, like in that range, like it was pretty easy to do, right? It wasn't hard to do. And then you slap some equities on it, you wrap it around and dress it up and have some real nice posters in the branch. And, it's a pretty good way to make easy money. But that doesn't work anymore because the world has changed. But these funds, so if you're managing this fund, or you're on like the investment committee, and I'm telling you, these investment committees, they have like 40 people on it. They sit around this big oval table, and they're allowed to participate in the investment committee. And then behind the table on the perimeter of the room is another group of people who are allowed to attend. I kid you not, they're allowed to attend, but they're not allowed to speak. And then you have another group maybe huddled in the corners who are there just to observe and stuff like that. But anyway, but these armies, so you're sitting on a $5 billion fund. You're collecting 2.2% a year in management fees from it. And you're tied to this anchor of a bond market where you can't do anything with it. What do you do? If you're the bank, you can't shut it down. You can't take this dramatic shift, because all of a sudden, just say you wanted to liquidate, say, 1.5 to 2 billion out of the Canadian bond market, and say the other banks decide to do the same thing at the same time. So now you're looking at, say, 5 billion maybe coming out. And then the pension funds say, well, yeah, we're going to do this. The whole thing just doesn't work. But that's not what they tell you. So instead,
what you're basically saying is they're too big to pivot. It's because they're a market maker.
Yeah, they're too big. And I remember chatting with like a financial planning person at one of the banks a few years ago. And I said, something like, you go in to do some banking, we all need a bank to do stuff. And I said, how does it work if I want to buy a mutual fund? Can I buy that fund, 0.1? They say no. I said, why not? They said, well, we need to do your goals and objectives. Okay, let's say we do it. This is what I want. And then finally, the person confided in me, and they said, we're only allowed to put you in balance funds at the branch level. I'm like, what are you talking about? Why can't I buy this equity fund or something else? No, we've been trained now, you only get the balance fund. So if you walk into a branch, no matter how big you are or how odd your investment objective is or anything, you put it into, the meat grinder, and what comes out, what plops out on your plate and it sounds like a plop on a plate as well. Like, it's not nice, guys. You get this friggin' balance fund. So here we go. So year to date, this balance fund is down 14%, 14% year to date. So that's what that investor is getting. Some of these bond funds, they're down 15%. So think about it. Most conservative investors are down 15%. Preferred share funds are down 14. Emerging market bonds are down more than 20. Junk bonds, high yield, are down 15. Like, this is it, everyone who's an investor this year. We've all lost money somehow, and some people have lost a lot more than others. And it's our view, because we're going to have periods where we're not right, of course, but if you recognize the world has shifted, the conservative investors should have been able to avoid these double-digit type losses that are out there. And I don't know how they make it back. Like, it's tough out there, Steve. But we have another 6 months left for the year, so let's see how they scramble.
I mean, it's kind of fascinating though, because I feel like, correct me if I'm wrong, but like, the people that it's just the system in society and financial markets are ultimately, let's call a spade a spade, and it's very similar in the housing market. It's kind of set up and designed for the wealthy to get wealthier, right? I mean, like, do you have to think about like who are the people that are going in and walking in at the branch level and buying a mutual fund? They're typically the kind of people that aren't necessarily as financially educated, or they don't have the net worth and the resources to, hire, let's say, someone like yourself, or someone even that works in, that's, because a lot of these advisors will have minimums, right? Like the good ones will have minimums of, 250K, 500K minimum investment. So you're kind of forced, you're kind of angled into, the bank's mutual fund. If you only got 30, 40, 50,000 bucks to invest, that's kind of where you go. And so you kind of get, mediocre results, I think, because you're hiring, mediocrity. I don't know. I mean, I always find that fascinating.
I think what's really great today, though, is that, there are a lot of good independent managers available around the world, but they're only good and great because of two things. One, they've recognized the world has shifted, but second of all, the tools, mostly through ETFs, they are available to give you the opportunity to get exposure to these new markets that are out there. And there's a lot of bad ETFs, a lot of great ones in the middle of the road. Like, it's not just as simple as buying a passive fund, but the world has shifted. And because I'm a believer in capitalism, and there are a lot of great ETF companies out there, manufacturers, especially down in the US, they're coming up with these responses to the world has shifted. Like, and then other places don't. Like, as an example, one of the big Canadian banks, they had an agricultural ETF a few years ago. So not in like farming stocks or fertilizing companies, but the actual agriculture, like corn, soy, and wheat, for example. And they closed it. And we had a position in it. And at the time I said, why are you guys closing this? And they said, well, it's not performing very well. People are not interested in it. And my response was, yeah, but that's okay. I'm holding it for a different reason, because at some point it is going to turn around, because the world will shift that way. But that's not the way most of the industry, the way they work. Like, I know a lot of the guys on the ETF side, and they'll say, yeah, Keith, we'll create 10 products a year, 10 new funds, throw them against the wall, and we know 9 of them will fail. So they know that they're going to sell these funds. People will put money in it. They won't do well. Then they'll just close them. But one of them is going to do really well and attract a lot of capital. So like, it's not fair, because the world has changed. But for people who are able to identify some of these markets are available right now, we do have a chance, right? Like, there's a good opportunity out there to at least avoid these. Wait till the June 30th statements come out.
What is it?
I know a lot of guys will be just their heads down on the advisor
side.
I
mean, yeah, but that's ultimately the goal of policymakers, right? I mean, I think it is this is what people are talking about now, but like real estate too, is like I think that they implicitly I think the Fed is trying to engineer at least a soft correction in housing prices, because that does kind of destroy a lot of discretionary spending, right? For example, we just had the Canadian bank regulator, OSFI, came out and updated their rules regarding home equity line of credit. So they're I'm not going to get into the technicalities of it, but basically what they did is they kind of tightened up a little bit around, how much sort of credit you can readvance to households, and that will begin at the end of 2023. So they did a slight tightening of home equity lines of credit. And I always look at that and say, well, yeah, I mean, I think this is the regulator's response of looking and saying, well, look how much like house prices have inflated over the last 24 months. Like, again, if we've got an inflation problem, I mean, that probably only gets worse if people start immediately tapping into that home equity, because that's more purchasing power for these people to go and spend. So, yeah, I just think like policymakers are clearly, tightening the screws from all different directions.
You like how the language has, again, I'm just fascinated. I just love, I think the industry, you can really win for markets. You can see when these slow shifts are taking place. And again, I just love it because I think it's very clear when you do see it. So as you just used the word soft landing. So that phrase wasn't being discussed 2 months ago. But now over the last month, more and more, the Fed is talking about it, and, the mouthpiece for the Fed, which is the Wall Street Journal, they're introducing it and so forth. And I saw an article on Bloomberg the other day. They're saying, yeah, it looks like we will achieve a soft landing in the US, and the Canadians will have the same stuff. But now they're admitting that a soft, for everyone to know, a soft landing means growth slows significantly, but not enough to create a recession and not enough to create dislocation in the economy and stuff like that.
And trying to stick that landing, like these guys are all guessing. Like I think we all have to understand that central banks are quite literally guessing. You even look at we talk about their data, right? Like I think Powell was out this past week at a conference saying that we were using, what were they using? The Phillips curve model or something. I don't know all the technicalities around it. The Phillips curve. Oh, we got it wrong. He was saying like 34 to 35 economists at the Fed, had inflation sub 4%, and 34 to 35 were wrong. It's like, and these are supposed to be the smartest guys in the room that like have all this data and these models that they've created, and they got it wrong. And so I think even at this point, they're guessing. So when they come out and say, we're going to try to engineer a soft landing, like, these guys are guessing. They're hoping that they can stick a soft landing with the controls that they have in front of them.
Yeah, they're making their best guess. That's what they're doing with it, and it is a thankless job. I know none of the central banks have ever been able to generate a soft landing. So for them to do it this time, it'll be absolutely incredible. I just don't think they're able to do it. The other thing I think listeners need to understand and appreciate, especially with the Fed, because we always talk about the Fed first because it's the reserve currency for the world. There's a lot more than financial market and economic inputs going into the decision. You have to understand the geopolitical side of it as well. And whether people understand or realize it or accept it or not today, the U.S. and China, they are at war in different ways. And one of the tools the Americans do have is the dollar, and with rates. So whereas the Fed will only talk about inflation and labor and stuff like that. I do know that behind the scenes, there's also the implicit agreement that an aggressive Fed raising rates when China is struggling domestically, that's bad for China, right? That's not good for them. So again, there's a lot of things going on right now. There's a lot of loose screws. I don't think anyone's really trying to tighten them up. I think someone's trying to take them out really and shake everything. But again, so that just tells me that the probability of more stressful events occurring is quite high. And I think that creates a lot of opportunities, especially on the currency side. So,
what do you have an outlook on the Canadian dollar?
Yeah, I think longer term, the Canadian dollar will become very weak relative to the US dollar. On cross rates relative to say euro, yen, and sterling and stuff like that, it will do a lot better. So, but
Interesting. Even given the levels of household indebtedness here, and I know everybody likes to talk about a housing bubble, but
yeah. So you have to remember though, Steve, like if there's a crisis anywhere in the world, money will flow into the US dollar. That will happen. If that crisis is happening and it doesn't affect the Canadian economy too much, so the banks stay okay, or they're not wobbling, the housing market just gets sluggish, then it's not a bad, because the whole oil exposure for Canada is a petrol currency, so that it'll do okay in that scenario. If it spills over that all of a sudden banks get into trouble, and just remind everyone, so for Q1, RBC, they had a negative charge to their loan provisioning portfolio. So which means instead of reducing earnings by amount they think they might lose in loans, they actually clawed money back from it. So they create a profit out of the past. The banks will report earnings again now at the end of August. That's when the next reporting cycle will come up. And that's where we'll start to see if the banks are starting to see stress and pressure on their loan portfolios, specifically mortgages. So it'll be a pretty big one coming up.
Yeah, I mean, I will say this, at least like from my perspective, from the housing side of things, like I think that housing is such a lagging sort of product that, like you're looking at the banks and you're saying, okay, well, like, I think they've already come out and there's been these, reports have been published that they are genuinely concerned about price valuations in the suburbs, just because like of how quickly they went up, right? Like it wasn't just cheap money. It was just like a pandemic that drove people's behaviors to basically leave the inner cities. And so the valuations there, while they are coming off rather aggressively, if you look at them on a year-over-year basis, right, they're still positive, they're still up. And so like real estate doesn't get marked to market, right? Like it doesn't happen in real terms. Like, when you're looking at the equity market, you wake up every morning, you look at the ticker and say, okay, prices are down, 13.5%, year to date. But it's like in the housing market, it's not a very efficient pricing mechanism. That's why it takes a while for house prices to correct, right? I mean, house prices can go down for 2, 3, 4 years. And they can go down, 6.5% a year for the next 4 years. Like, so because housing, again, the way that it works is just like, it's an emotional product, right? People are selling their primary residence that they've lived in for the last 15 years. They are very reluctant to cut their prices. They always think that they have the best house in the block. And so, yeah, they might look and say, well, I don't care, Mr. Realtor, that sales are down. My neighbor sold for this price 2 months ago, and I want that price or very close to it. And so they're very reluctant to cut their prices. And a lot of times, sellers might sit on a price for 6 months, then reduce. So on that price for another 6 months, reduce. And then, a year and a half later, you finally sell at a much lower price. And so, yeah, I just find that housing, and if you're looking at the bank's books, and that's why, like, people always talk about, oh, when's the wave of foreclosures? Like, foreclosures take a long time to play out, especially in Canada, right? Like, so if you miss a few payments, like the banks will give you some time to catch up. They'll send you a letter. You miss a couple more payments. Okay, well, now they're starting these sort of court proceedings. And then in BC, where I am, from the day that you miss like your first payment to the day that you get foreclosed on and have to hand the keys over to the new owner, like that's typically on average about an 18-month to 24-month process. So when we're talking about like foreclosures increasing in like most of Canada, we're talking like that's probably an end of 2023 story.
Yeah, that's in the housing market, but for banks and their loan portfolios, they try to be proactive with it, because you don't want to have, no expenses for bad loans, and all of a sudden it hits and you got to wipe out, say, 2 quarters of earnings. Instead, banks like to put aside a little bit every single quarter, so then we'll catch up for it. So for us, we will be watching the the Q2 numbers that come out, and RBC again, like they'll be the big one, because like everyone took less of a provision in Q1. So you want to see which direction did it go. So what I mean by that is everyone increased, everyone put money aside for a rainy day for bad loans, except RBC. They took money out of the rainy day cushion or safety net. So we'll see this coming, and it'll give us a good sign of where they anticipate things are going.
How do you? I'm just curious to wrap up the show here, but how are you looking at the Canadian banks in terms of, I think, like the index now for Canadian, the big five? I think year to date they're down about 20% between those big five. Do you think it gets cut another 20 from here?
Well, if we go into a recession in Canada and around the world, the banks will come off, because banks are levered entities. So whereas, just say you're a big industrial company, you might be levered, say 2 to 1. So you borrow all this money to build a factory and stuff like that. I know you amortize it over time and all that stuff. So you get operational leverage or leverage, whatever word you want to go with that. Banks are levered anywhere from 10 to 20 times. That's what they are. So when times are good, banks make a ton of money, and why shouldn't they? Because they're levered. And here in Canada, they have no competition. You'll say, well, that's not true, IceCap. They have lots of competition. No, they don't. There's 5 of them. Like if you're TD, you want to take market share away from Scotiabank in this one area, and you try to do it, you're going to lose it somewhere. Like it's all there. Yeah,
you could say the same for the telecom business.
Yeah, absolutely. Yeah, it's a tough one. Telecom death, by the way. But as of right now today, Canadian banks are in trouble. Like it's not like 08, 09 or anything like that, but they are exposed to a housing market that potentially could correct. And we won't go through all the reasons for that. I think everyone is well aware of it. But if we do get this external market event taking place, it could come out pretty quickly, and then people will all of a sudden, Canadians will say, oh wow, Canadian banks, they are exposed. But as of right now, everyone in our lifetime, that we've all made a lot of money on our bank stocks, and it's been fantastic. But the risk is there that something goes off. So when you make an investment, there's always risk involved. That's why you have to control your exposure to it. Make sure you have liquidity. Make sure you have an exit plan and stuff like that. But again, like from a cultural perspective, the majority of investors in Canadian bank stocks, they do not see the risk, and that's because they've never experienced it before. And we're just saying, hey, if it happens, oh buddy boy, you're going to feel it at that point, and it'll affect the whole market. I mean, the Canadian dollar will come off and stuff like that. But again, if that's happening, it likely means the rest of the world is off
kilter
as well. Yeah. Anyway, big kitchen party coming up, right? That's
big kitchen party at the IceCap household. Date to be determined. But Keith will be firing up some pizzas. So
1 hour notice. That's it. This is going to be like a 1 month thing.
Everybody show up to the IceCap Palace. But no, in all seriousness, we got a lot of big things planned for the Loonie Hour here. We are again working with some sponsorships, and we will be having a lot more events, giveaways, really just continuing to try to build the community. The feedback has been amazing, and as Rich said, I think this is one of my favorite times of the week, is just sitting down to record this. And so we really appreciate everyone's ongoing continued support. All we ask is that you share this episode with at least one friend. Let's continue to build this one by one. So as always, we'll see you next week.